So the Federal Reserve last week cut interest rates by a quarter point. Now, many of you are going to say, why did the market go down? We were all expecting them to cut a quarter point. It was pretty much telegraphed that that was what they were going to do. I think it was close to 100% chance that they were going to cut 25 basis points. But yet the market took this as a big negative for some reason. And on that day, the Dow Jones went down over 1,000 points. Markets lost between 2.5% and 3% in just one day. What happened? Well, I can tell you that many people believe that the Federal Reserve actually shouldn't have cut interest rates. And in fact, there were some on the Fed governors that sit on the at the Fed and on the board there, and they said that they didn't believe they should be cutting. So we actually saw some dissension there. A couple of Fed governors actually did not agree with the move, and I think that started to cause a bit of ruffling of the feathers, if you will. And it was one of the first times that the Fed cut with not a unanimous decision. So that was a bit of a negative. We all believe that the Fed, because of all the talk going into the meeting, they were kind of put into a corner. They almost had to cut that one last time. And so for 2024, it looks like we're going to get a full percentage point cut. The rates coming in, the Fed funds rate coming into 2024, we're 5.25%, 5.5%, and we are going out at 4.25%, 4.5%, or if you want to take the middle range, the middle point of the range, 4.38%. So that's where we sit right now. So the fact that the Fed cut when the data actually hasn't really warranted another cut kind of leaves investors wondering, okay, well, if the Fed isn't data dependent as they say they are, what can we, I guess, expect from the Fed in 2025? They tell us they're data dependent, but yet they don't move based on the data. So a bit of a controversial situation. I know some people have actually called the Fed out and Jerome Powell out and saying, calling into question what the Fed is actually doing. The other thing that they said that the market did not like was they said the inflation was coming down overall, but it's sort of stalled in and around 2.5%, 3%, where it's been sitting for the last few months. Market did not like that either. The Fed has said because of that and because of the strong economy, strong employment numbers, that they would probably only need to cut 2 times next year. That's the base case. We'll see what actually happens, again, depending on the data. And once again, the market was hoping for more cuts next year. So the market had, unfortunately, many reasons to fall in the US. And as we know here in Toronto, TSX tends to follow what they do down in the US. And when the Fed is causing the markets down there to fall, our markets and global markets actually react negatively as well. A few charts that I wanted to show. The first one being US inflation. We see US inflation, there it is. US inflation and interest rates. So you see here, 4.38% is our black line. It shows where interest rates are in the US. 3.3% is core CPI, again, consumer price index, measurement of inflation. Core strips out energy and groceries and food. And then you have the headline CPI number, 2.75. So again, in that 2.5%, 3% range. You want to go next to PCE. We had a PCE reading, which is another inflation reading. That was given to us last Friday, personal consumption and expenditures. This is the more favored data that the Fed looks at to decide whether inflation is running hot or whether it is coming down. And you could clearly see here that it's pretty much flatlined in the last little while. Again, in that 2.5%, 3% range, remaining stubbornly in that range, not wanting to come down to the target, which is 2%. Although I will say that the Chicago Fed, Austin Goolsbee, made a comment late last week saying that actually, if you take a 6-month reading, the last 6 months of PCE, it actually comes in and around 2%. So that is definitely a positive. So 2.8 on the core PCE and 2.4% on PCE itself. Our next chart I want to show is what happened. As I said, the markets fell quite a bit on the day that the Fed announced their 25 basis point cut last Wednesday, and look to see what happened in the market. Dow Jones fell the least amount, but still quite a bit. S&P 500 came down in and around that 1.5–2% range, and the Nasdaq, which is probably your more interest sensitive index, where a lot of the tech names reside, fell in and around 2–3% in that range. So it was a pretty negative day. Interesting for us here in Canada, the effects of the Fed only cutting a quarter point and talking hawkishly, talking about how they would not be cutting as much next year. And what we've been hearing from the Bank of Canada, talking about how they will continue to cut, maybe not 50 basis points, but 25 basis points. Well, you can imagine what happened to our dollar. If the Fed is not cutting and we're cutting up here in Canada, the Bank of Canada is cutting, our dollar will continue to fall versus the US. And we have that chart here, if we can show it, which is our currency. And yeah, we actually have the broader index. So here's the US dollar moving up higher versus all the currencies. So the US dollar versus the Canadian dollar, the Australian dollar, the South Korean dollar, Indian rupee, all of them are falling versus the US dollar, which is rising. And again, that is all to do with the Fed not cutting as much, the policies or the potential policies that the new administration could put in place come the end of January when they take over the White House. A lot of America First policy, and that obviously helps strengthen the dollar. The next chart that I believe we have here is actually, I can tell you, I don't think we have the chart, but it is a chart showing a 69-cent Canadian dollar. And basically, our dollar fell below 70 cents on the day that the Fed announced that quarter point cut. We've seen it bounce back slightly in that 69.5, 69.7 by the end of last week. So we saw an initial downturn because of only a 25 basis point cut and the talk hawkishly talking about interest rates going forward. We saw our dollar fall well below 70 cents, down to 69 cents. And we saw a little bit of a rebound at the end of last week. But overall, our currency continues to be hit as the U.S. is talking a lot more positively. Their economy is strong. Their retail sales are strong. Their unemployment numbers are really low. GDP growth in that 2.5–3% range. All that much better than how we're faring up here. And therefore, our dollar has been falling versus the US dollar. So overall, let's see what happens in 2025. The Federal Reserve talks hawkishly. They probably will only cut once or maybe twice during the course of the full year. We'll see how we start the year. Hopefully, we can end this year on a positive note with a bit of a Santa Claus rally into 2025. But overall, the Federal Reserve will continue to dominate the headlines and affect the markets in general.